Hello, everyone. This is Sam Celery, founder and chief technical officer of Celery Signals. I want to put out a little video blog today on something that we've been discussing internally here at Celery Signals for some time, but I decided to do some digging and found some evidence that supports our theory here that the Fed is, stuck in a corner here. They meet in Jackson Hole along with other central bankers later this week to discuss, the economy, monetary policy, which basically means stimulating through either low interest rates or even printing money, which we've had trillions of dollars of printed assets over the last, few years. So the question to us is, can they raise interest rates, and how will that affect the economy? Well, our opinion is yes, they might raise it a quarter of a point or more here in the near future. But again, that we're at such low levels. Our theory is that what the Federal Reserve knows that the general public does not is that the wealth effect is the only thing really stimulating and keeping this economy going. And should raising interest rates spook the speculators in the financial markets, what would that do to the wealth effect and therefore the economy? And so what I wanted to present to you here today is quite a divergence. You have a chart that is the Dow Jones Industrial Average in blue, and laid over it is U.S. wages and salary growth in black. Well, you can see that salary wage growth peaked in the late 70s and has basically been coming down ever since as the stock market has been rising against it. But as we zoom in specifically to around the late 90s and early 2000s, you can see that wages grew as the stock market grew, and when the stock market fell, wages fell. And then between 2002 and 2008, wages went up and the stock market went up. And then from 2008 to 2009, 2010, the stock market fell and wages fell. And then they both came back together until about 2012. And since then, average wages in the United States have been relatively flat, but the stock market has just gone gangbusters. And so, what is the wealth effect? Well, that's mother or father coming home, taking a look at their 401k statement or their brokerage account and saying, I'm up 4, 5, 6% this quarter. Man, I feel good. Bank account's fat. Honey, I think we can go on vacation. Honey, I think we can redo the backyard. Honey, I think we can get that new refrigerator. So they go out and they consume goods and services, keeping the economy going. But if the stock market contracts and those assets, those statements contract in value, it contracts the perception of one's wealth, and therefore they make different decisions. They don't go out and consume. So it is our opinion at Celery Signals that what the Fed knows is that they have to keep interest rates low. They have to keep propping up the stock market because the only thing really keeping it alive is the wealth effect. Because if you look underneath the surface, the 95% of Americans who or 90% of Americans, or whatever the larger percentage is that does not invest, since 2000 are not even making the same amount as far as wage growth is concerned, and in fact making less. So if the market contracts, certainly wages across the board will contract. But as you can see here, quite a divergence in wage growth and the market at all-time highs. So something I wanted to bring to your attention. Keep this in mind. I think the central bankers of the world are becoming more and more under significant pressure. And I don't know how this plays out, but my guess is that it poses difficult circumstances to us at one point or another. So thanks for your time, and have a wonderful evening or day tomorrow whenever you're viewing this. And find out more information about us at sellerysignals.com, SELLERY.